Today's market has a PE of about 30. Historically, we've been there about 18 times based on 10-year trailing earnings. At 30, the average return to the market over the next decade has been a low of about 2% and a high of about 8%, and an average return of about 5%. So unfortunately, that's the valuation level of the S&P 500 today looking forward. And we can get 5% by throwing a dart in the bond market for 10 years.
Yeah. Now, where this leaves bonds, though, if the Fed doesn't cut, won't that be a problem for bonds?
Yeah, I think, you're going to see a gradual re-steepening from the back
Mm-hmm.
end. Then an eventual cut in the front end that brings back a more normalized curve. It's just going to take a little bit of time. The big rally that we had in bonds finally last year, where, the aggregate market was up 6% or so, is not likely to be repeated this year, but you're likely to get your coupon. So, you're starting out the year with a 5+% coupon, in the aggregate market. And, as the year progresses, I think you're going to get, a very coupon-like level of income, which is, something you haven't really had the chance to do in a long, long time, maybe 15 or 16 years.
Long and short of it, it sounds like you're saying bonds are a better deal to invest in right now over the long term than stocks.
What I would rather do is lever up bonds 3 times to get the same volatility of the stock market, and you'd end up with a better result over the long run than you would if you just had stocks on a risk-adjusted basis.